This is Digital Perspectives with Brad Kimes. Subscribe for new content notifications. Now, here's Brad Kimes. Come on in.
Welcome back to the show, everybody. You know what time it is, and we are with Dave. Well, I always want to say Cryptopolis, but it's Dave Vallieres. Isn't that right, Dave? Isn't that the name, the full name there?
Absolutely.
How are you this morning, Dave?
I'm doing great, Brad. How are you?
I'm doing really good because we got a new guy hanging out with us today, and it's Steve Van Metre. Steve Van Metre, good morning to you.
Good morning, Brad. Thanks for having me on your show.
Man, look, it is a honor and a privilege to have you on the show today, and I want to let everybody know that we're going to talk about some economy stuff, how it may correlate to a lot of us as retail investors in the crypto space, and we may even touch, before we get out of here, some of the recent stuff that's happened with regulatory news and what's going on internationally with policy and stuff towards cryptocurrency, especially in the cross-border payments realm. But before we do, we want to open this thing up with letting Steve tell everybody just a little bit about yourself and your background, if you could.
Sure. Thank you. I'm a macro fund manager and inventor of Portfolio Shield. By day, I manage money and help plan for people's retirement. And by night, I'm studying macro and trying to learn all the things that you talk about on your show.
Well, let me tell you something. You really do, too, because I just watched, as I told you off camera, it was about an hour plus minutes or whatever of you on Real Vision. And it was one of the best conversations I've heard about the economy since watching some Milton Friedman videos. I mean, it was just remarkable. So let's kick this thing open. Dave, where do you want to start today with Steve in the conversation?
Well, Steve, I just want to thank you so much for being here. I just feel like I know you so well because of all the YouTube videos I've watched with you in it. I mean, your channel is absolutely fantastic. It's educational. It's really low key, but boy, you explain the complex stuff really simply, and that's really difficult to do. And I appreciate your channel a lot. And your name is Stephen with F-V-E-N, Van, V-A-N. And your last name is M-E-T-R-E. Is that correct?
That is correct.
And that's your YouTube channel as well. And I recommend that everybody go check out your YouTube channel because I think it's just absolutely incredibly educational. If you're into macro, if you want to learn more about macro, I highly recommend your channel. You're welcome. One of the things that I see a lot on Twitter, especially when we were back in March, late February and early March, when the stock market really declined very, very sharply, was the fact that the Fed was going to step in and provide liquidity to the market. And now you and I both know that they say one thing and maybe they're doing something else, but they had this impression, they're giving confidence to the marketplace that they're going to step in and do whatever they can. I mean, and there's no limit to the amount of money printing, or at least that's what a lot of people were talking about, money printing. Does the Fed actually print money and provide liquidity to the market is my question. I don't think it does, but let's hear your answer.
Yeah, and those are almost two separate questions that we need to kind of look at from different angles. And I think that is a great question because there's a lot of misunderstanding in March. You know, of course, we always hear the Fed say, as you mentioned, what we want them to hear to say. You know, it's like going to your parents and saying, hey, can I have some money for an ice cream? Sure, you can. It's like, you always want to hear that certain answer, and the Fed's always going to give it to you. So let's address the first piece. Can the Fed print money? And the answer is they cannot. The Federal Reserve Act of 1937 prohibits the Federal Reserve from printing money. So when they came in and said, we're going to do quantitative easing, and we heard Fed Chair Powell on 60 Minutes said, we're printing digital currency. Well, that's not true at all. In fact, we actually heard Ben Bernanke back during the great financial crisis make a very similar statement of saying, hey, we're printing money. And then later on, when, well, no one was really paying attention, he quietly said, yeah, we really can't do that. Now, where does this liquidity injection come from? Because the Fed actually can inject liquidity in the short term, but not over the long term. And it's not through quantitative easing. It's through what are called repo loans or swap lines. So what you see is the Fed will take Treasury securities on loan for cash, or with foreign central banks, they'll take foreign currency on loan for cash. again, all of those are loans. They do have to be repaid in dollars. They have a term. They're not indefinite loans. Sometimes they're as short as 7 days. And I think we extended them as far as maybe 30 to 90 days in all of this. That is the only way the Fed can inject liquidity. The problem with that is they have to be paid back with dollars. So the end result is whatever liquidity came into the market to solve the problem eventually gets pulled back out when those loans are paid off.
Okay, so we are in a debt-based economy. I mean, in order for us, for example, the commercial banks, if they lend, that's basically money printing as well, right?
Well, I wouldn't call it money printing. I would say that that is how money is created. So when
Right.
banks lend to consumers and businesses, so for example, for your listeners, let's say you went down and buy a car and you finance it. The money that is financed is brand new money created into the economy. So it's not really money printing. It's just how the system actually works.
Right. So what happens? So lately, of course, we've been in this pandemic now since the beginning of the year, approximately, and we've seen, and I watch your reports every week, and really the amount of lending that's going on by the commercial banks has been declining. What is that going to lead to, and what does that really spell for the economy?
Well, that's a great question because the lending data is something almost nobody looks at. And on Fridays at around 1:15 Pacific, what's called the H.8 credit data comes out from the Fed. It's probably my favorite data source that nobody looks at because it really tells you everything. So in a debt-based economy, you need a constant expansion of debt. And ideally, you need that expansion of debt to run at a certain rate. And when you see a deceleration, or even worse, as we're starting to see now, a contraction in that debt, that tells you that money is being destroyed when it contracts. And in a debt-based economy, that leads to asset prices falling, leads to weaker economic data, weaker economic growth, and is not something you want. The problem is the Fed has no direct tools to stop that from happening.
Right. So, I mean, we understand that the lending has declined. I mean, there's a lot of reasons, right? I mean, we got nearly 30 million people unemployed in the country. That's going to really reduce loan demand. But also, the banks have been tightening their credit standards.
Yeah, that's a great point. So right now, as of this week, or as of last week, we have 25.25 million Americans on some form of state or federal unemployment benefits. And last I checked, you can't get a loan when, if you list, say, where I'm at, the state of California as your employer, and you cite your unemployment benefit as your income, that really doesn't work at all. So what we've seen is banks tighten lending standards, and they're doing this for what seems like the obvious reason is there aren't that many good customers out there to lend to. Now, there's another factor too. Rates are fairly low. And so if you look at and say, okay, I want to borrow money, maybe say 2% over a 30-year period. Why would a bank want to do that? I mean, Dave, you wouldn't give me that loan if I said, hey, Dave, can I borrow 100,000 for 30 years at 2%? You'd be like, yeah, probably not, because the risk is to you. There's not a lot of money to be made on that loan if I default. And the risk you have as a lender is, well, could I repossess that asset to Steve Post as collateral and hope that it's worth enough that I can sell to get my money back? And right now, that is not the case. The banks are very nervous. And so they're tightening lending standards because what they want to do is they want credit to constrict. And I know this is an odd view that not many people have, but I do, is that the banks want lower interest rates because they need high quality credit borrowers to come in and borrow. Now, who are those people? Well, they're the people who don't want to borrow. They're the rich of the rich who have, we see in the data that most of the wealth right now is concentrated in a small number of people. And it's at one of the most extreme positions that we've seen since the Great Depression. Well, the banks need them to come in and borrow money because they know those people will pay it back. Problem is, they don't need to borrow money. They have money. There's no opportunities out in the market. So what we see with the banks is as they tighten lending standards, that causes interest rates to come down, which again tightens financial conditions. And effectively, they're forcing not only the Fed's hand to do more, but they're going to force the federal government into backstopping loans down the road and offering guarantees to make the banks feel safe about lending at these low interest rates.
Well, if interest rates are already low and it looks like they're heading even lower, In fact, the 30-year note or a bond this year was at 2% early in the year. It dropped significantly during the March decline. In June, it was up around 1.6%, and it looks like it dropped again. And that 1.6% seems to be like some sort of ceiling. It hit 1.6% early this month, or maybe the end of September, I forgot, and then it's dropped back down again. So even though we've got lower interest rates, we still have, a fairly good sized workforce, even though we've got a lot of people unemployed. Where's the growth in the economy going to come from then?
Yeah, that's the big question, right? I mean, that's what we're all looking for, is where does the growth from the economy come from, because it's going to have to come from fewer and fewer people. And as we look to those who are employed, well, a lot of them are really nervous. I mean, I don't hear a lot of people saying, hey, I'm super confident about my job, so I'm going to go out and borrow a lot of money. What we are seeing is people fleeing cities and buying homes away from the big metropolises, and that's caused a big jump in demand for housing and residential real estate. But what is not translated to is into lending growth, and that's what's really interesting here is we're seeing all of this activity going on, and we're still seeing credit decelerating. And now, as of last week, commercial industrial lending was contracting on a 90-day basis prior to this. But last week we saw residential real estate contract. And it's telling us that there are fundamental problems in the economy. It's telling us the Fed's policies aren't working, and the stimulus isn't working. It's telling us nothing is working, but nobody's really noticing what's going on here.
So how far do interest rates have to drop before
Exactly.
it starts to stimulate more economic activity?
Exactly.
Yeah, and that's a great question, because the question nobody knows is how far do they have to go to actually create demand? So as you mentioned, the 30-year was below 1%, and then the ceiling seems to be around 1.6. This morning it's at 1.5. And what I like to try to help people understand is, the broad market's view is interest rates have to go up. I mean, there's no way, they have to go up. But if we look at, the lending data, it tells us there is an insufficient demand at current rates to spur lending growth. So what does that mean? From your just basic supply and demand stuff we learned, in macroeconomics, 101 in college. If there isn't enough demand at a certain level, then the rates have to fall to get to where that demand is. The problem is we don't know where that is. And most people think, well, there'll be demand at zero. Well, maybe, I'm one of the few people who said zero will be inflationary in the terms of it'll be a psychological inflationary level, but it may not actually lead to enough lending growth. And the problem with that is you have the baby boom generation who is, in or near retirement. And as the longer the pandemic goes, are being forced into retirement. And in retirement, you don't borrow, or if you do borrow, you're borrowing to refinance your debt to a low rate so you can pay it off quicker. So that puts the burden on Gen X and the millennials to not only create enough lending growth just to keep the natural level up, but to completely offset the boomers as they pay off their debt. I don't think Xers and millennials can do that. So will zero be low enough? I'm actually not sure.
Let me ask
that's actually a great point. Go ahead, Brett.
Yeah, I just wanted to ask because, to your point about whether zero would be good enough, what are your thoughts? Because the Bank of England has talked about, they've floated the narrative that they're going to go negative over in the EU, or actually the ECB has talked about this. And we've also, had the conversations, not as heavily here in the United States, but what are your thoughts about the US as well going negative if zero is not enough to inspire the consumer to spend, right?
Right. Okay. So let's kind of separate what we're talking about, because what you said, there's some valid points of it that could confuse people very easily. So when I refer to zero, I'm referring to treasury yields. When what you just referred to, Brad, with the ECB is their version of the federal funds rate. Right. So the Fed is effectively sitting at zero on the federal funds rate, and it's not going to go negative. A lot of people think it will. However, the Federal Reserve Act suggests very clearly that it's can't, not without a change, because they do have to pay interest on excess reserves. And so there's no mechanism at a negative policy rate for them to accomplish that goal. So when I refer to negative rates, I'm not referring to the federal funds rate. I'm referring to the Treasury yield curve, which the Fed can influence, but does not have direct control over. So I look at perhaps 30-year Treasury yields could be zero. Mortgage rates could be, say, 2%. And that still may not be enough to get enough new people out borrowing money and creating new credit to create enough demand to offset the currency destruction of zero interest rates.
Well, in your, I believe it was, maybe it was Monday or maybe it was last Friday. I can't remember when you did this video on Dr. Hunt's latest report. And a couple of things that you mentioned in there were the demographics. So for example, we have a lower birth rate now. Actually, one of the lowest birth rates since 1918, which was at the time of the Spanish flu. And so a lot of demographics have changed. When I was growing up, I was a teenager in the 1970s, late 1970s and early 80s. And interest rates at that time were closing in on 20%. We had silver that ran up from $6 to almost $50. And I remember going into a hotel room with a bag full of silver dimes and selling them just about the month in which that peaked. And we had all kinds of inflation. We had the oil crisis back then. We had a lot of things going on. But at that time, I'm at the tail end of the baby boomer generation. And I mean, at that point, I was just getting into my earning years and I was starting to buy houses and I hadn't had a family yet, but I was getting, to that point. But a lot of boomers were ahead of me who were already into their high spending period of their life. Now we just don't have that. We don't have the demographic there. So, are we going to be Japanized here? Are we going to go into that long period of low interest rates, low growth, low velocity of money that Japan has seen?
Yes, absolutely. Barring any changes to the financial system, monetary system, that is the direct path they're headed on. And so, when you talk about the Japanification of their economy, what they did, so your viewers can help, maybe understand a little bit better, is Japan's solution to their economic malaise was to borrow more money. And so what they saw as a government is, well, interest rates are going down, so I'll just borrow more. And then as they kept going down, they could borrow more and more and more and more. And the notion was that at some point we'll borrow enough money, it will be stimulative. And well, since 1980, effectively, it was it 1980 or 90, their market peak? I always get the decade wrong. But for 30 years, they have not found that the solution worked. And the reason is, and Dr. Hunt's research is absolutely excellent, because what you find out is that the Japanese government overused its debt. And this is something that we've seen in the Eurozone, and we're seeing in the United States, is the more we borrow, the lower rates go in a debt-based economy. And a lot of people think, well, shouldn't the federal government have to pay for its wasteful spending? No, it actually works the exact opposite of what most people think. Is the more the government borrows, the lower rates go. The less they borrow, or if they run surpluses, the higher rates go. So when the government looks at this picture, is when rates are high, they should do a lot of borrowing. When rates are low, they should do a lot of budget cutting and try to run a surplus and pay down the debt. The problem is they see the exact opposite, because hey, if rates are, say, near zero, why not borrow more money? Well, the problem is it doesn't work, and the people running the show haven't figured out that it doesn't work. So at the current trajectory, barring any significant changes, not only will we look like Japan, we are about 8, maybe 10 years behind them, and we're right on their tails.
Yeah, austerity is a dirty word in government right now. I mean, higher savings rate, higher interest rates, giving an alternative to risk assets is really an issue, especially for those getting ready to retire.
Right. If you look back, to the Great Depression, effectively what we did is go through a period of austerity. Now, the government did cut spending. And even though, some people say, well, they did end up spending more money, they actually were actively cutting, but consumers, were effectively forced into a long period of austerity. And it worked as they paid down the debt and they got their balance sheets cleaned up. The economy took off. But today, to talk about austerity to the baby boomers, They don't want to hear it because they already know that their pensions are underfunded. They know Social Security is underfunded. They know Medicare is underfunded. And the reality is, if to have that all properly aligned, that means they're all going to have to take cuts. Well, they don't want that. And I don't blame them. I wouldn't want it either. The challenge is you've got two generations, the millennials, which are slightly bigger than the boomers, and you have the Xers, which are smaller than both of them. And we're not big enough to make up that shortfall. And so the solution is, well, we or at least the appearance of the solution is, we can't let the boomers down. So we'll keep trying to do things to keep it going. And the risk of that, of course, is, as we all know, is eventually the system fails and you get a massive recession and you get a forced austerity instead of willing austerity.
Well, right. And so one of the real worrying points, I guess, as speaking as a baby boom, is that and for my kids and my grandchildren at this point, is that the private and plus government debt to GDP has risen dramatically. I think I don't know where we are right now. I think it's around 128, 130% or so of GDP. And so I heard Dr. Hunt talk recently. I keep referring to him because he's such a great person, great individual to listen to. I mean, he reminds me of a modern Milton Friedman. He's just really terrific to listen to, very, very entertaining, and really knowledgeable. And he said that it's only really this high level of debt to GDP has only happened about 3 times in our history: 1870, 1929, 2008, 2009, and now in less than 12 years, it's happened again. Can you speak to that? What is the end game? And we've got the stock market just continuing to race higher. We did get a sell-off in March, but nothing like what we saw in 1929, 1932 period.
Well, we actually in 1929 did see a sell-off and then a rebound, although this rebound is much bigger and filled with far more enthusiasm. But yeah, Dr. Hunt's research is outstanding. He is a required read. In fact, I often read his reports at least 3 times, highlight them, make notes on them. And, I encourage your viewers to, start to look at what he's saying. And it won't be easy to understand. I mean, the first time you read it, it won't make any sense, and that's okay. But if you make a commitment to it, and then I think, Dave, as you mentioned on Monday, I went through part of his report to help people understand that on my show.
Yeah, it was great. That was a wonderful explanation and kind of a walkthrough of his report.
Yes, thank you. And so what we have is this overuse of debt. And as you mentioned to your children and grandchildren, what are they going to face? Well, they're going to face a period where there's just too much debt. And that too much debt is going to lead to fewer jobs, because what people can't see is the federal government is crowding out the private sector. And the big risk that, the baby boom generation has is when the Gen Xers, which are starting to get, have been interested in politics, but it's really the fear should be when millennials realize that not only should they be interested in politics, but if they can convince the Xers to vote with them, they're the majority. And that is the biggest fear, because the millennials know the system isn't working. They don't know why. All they know is a lot of the things that they believed and they were told, go to college, go to the best school you can get. Don't worry about taking on debt. Get the best degree you can get. The workforce will be waiting for you. You'll get a good paying job. You'll be well respected. And literally everything they kind of thought was supposed to happen hasn't worked. And they're starting to realize very slowly that it's not them, that it's the system that isn't working. And you see that, as you mentioned earlier, Dave, in the birth rate. Why are people not having kids? Because it used to be in this world, one income could support a spouse and a couple kids at home. Now you need 2 incomes and you're not sure if you can afford to have a kid. Right. And so, people are starting to figure out the system isn't working to their advantage. And the risk everyone has is when the millennials realize they do truly have the power. And if you are a millennial and you are watching this video, you do have the power. You just don't know it. And this may be the last election where we see some, 70-year-old white guy running for office, because we may in the next election get a very young, 30-year-old millennial. And if they can get the Xers to vote with them, the world better watch out, because they're going to want to make changes, and they're going to want to make them so the world can be what they thought it should be.
So
do you think go ahead, Brad.
just real quick, I wanted to build, it was kind of building an extension off of Dave's question and part of your remark there. What turns this around to safe harbor? Like, how did you get this turned around in your estimation?
Well, you either get a complete change in the system, which I don't believe is, well, there's the short term and there's the long term. The short term way is you go to some form of money printing that everyone thinks is the natural answer, and then you get hyperinflation and everyone will wish that never happened. Or you go through a period of austerity where people realize that, okay, this isn't working. We need to revamp the Federal Reserve. And when I say revamp it, I'm not suggesting that we go to a money printing solution. Is we need to give them the tools and we need to update the system to the modern world. I mean, you're a show that you talk a lot about cryptocurrencies. Well, there's a lot of ways that technology, and I'm not suggesting that any one of the current coins will certainly take over the system. But if you look at, we have a technology that could replace the banks, that could make central banks more efficient, maybe even do away with them. And we're not talking about it because we're in this old archaic system built by the baby boom generation. And we're trying to cobble it together to keep it going. And it's just not working. But what it will take is somebody younger who understands this and says, look, we're going to change the world and we're going to use all this technology that we've got. But before all that happens, the whole system not only has to fail, and then we'll do the same thing we've always done to try to fix it, and it'll look like it's fixing and it has to fail a second time. Then all of a sudden you'll watch people come out and say, let's start talking about getting an answer here.
Dave, go ahead with the next thing, but I do want to caveat and come back and touch on that notion of central banks and the new technology at some point about crypto, because I do want to touch on the cross-border payments issue and banks not having to, and small medium enterprises not having to pre-fund accounts all over the world for the first time and getting access to this quick cash, and maybe that can help jumpstart some issues there as well. Go ahead, Dave.
Well, I think that the millennials are so used now to everything being digital and being very, very quick. So you had, they grew up with the internet already. They have, they buy online, they do everything digitally, they can transfer money online and just a click of the button. They don't need to walk into a bank branch ever. Those are going away like Blockbuster. And so you have nothing but a digital economy. And so it makes a lot of sense that, in fact, if they were to come into power and they start to, and I think that's obviously inevitable, they're going to try to transform the economy into something more digital, and maybe digital ledger technology takes a form of, better reporting, more transparency, and all of the things that they really value. One of the things I do see, though, is the cynicism in millennials is, look, we don't let businesses fail anymore. We don't have that creative destruction. We don't have we don't let the companies that have taken a risk and failed leave the system, get out of the economy and get replaced by new innovation, hard work, and all the things that really make for a productive economy. Look at PPP. So we've got PPP coming in, is basically saying, look, we're going to lend you money to keep you alive. And it's because of this health situation. And then when it's over, pay us back. And if you can't, we'll just take everything you own. What's your opinion on the PPP? And also the fact that it doesn't seem like we can't let any businesses fail anymore.
Yeah, and this is a touchy subject because on one hand, you want to say that, well, we shouldn't have done the PPP because businesses fail. The other side is the PPP loan was necessary in the fact that it wasn't a lot of businesses' fault this happened. But what we're teaching people, we're teaching your children and our grandchildren, is that it's okay to fail. Someone else, in fact, don't worry about it. If you fail, we'll just prop you back up. And the answer is no. That's not how people learn. That's not how the world works. And I've often been a proponent that, parents should let their kids fail as early as possible. Let them learn that lesson, because the sooner you learn that, hey, failure isn't the end of the world, that you can learn from that experience and turn it around, that you can become a bigger and more productive part of the society. And businesses should be able to fail. I mean, we have bankruptcy laws, which are phenomenal, and people are almost afraid of them because what bankruptcy laws do is they take an organization, get rid of the management that drove it into the ground, and they go to courts. The courts give the company back to the employees. See, this notion is that, oh, well, if we had bankruptcy, everyone's out of jobs. Nope, not how it works. So right. you give the company back to the employees where it belongs. They then go out and hire new management, go out to the capital markets, raise new money, and revitalize the company. That's the way the system should be. Because, if I have, some machines that I bought and then I run a terrible business and I'm bad at it and I lose money and I fail. Well, Dave, you should be able to come by and buy those machines out of bankruptcy court, maybe for half the price, who knows, but at a lower value or at a price low enough where you can say, look, maybe Steve had a great idea. He just had the wrong time, or maybe he, focused on the wrong market, and you come in, buy him up cheap, and then you start a new business. Maybe I eventually come and work for you because you say, hey, this guy he does know something, but he was just the wrong time. And that's what people don't get. Bankruptcy has a valuable place in our economy. We've just taught people that, don't worry, you fail, the government will solve it. Well, the reality is, in the next recession, we're going to find out that all this stimulus, all this quantitative easing, all of this, central bank wizardry doesn't work, and it can't save everything. And when that happens and the global economy goes down on a faceplant, perhaps we'll get back to those, old values that you grew up with, Dave. I grew up with. Brad, I don't know how old you are, but so I don't know if you grew up with them too.
No, I grew up with them too. Don't let the looks fool you. I'm almost 50, so.
Oh, okay.
Yeah.
So we grew up with our parents, letting us fail.
Yeah. Yeah.
And we learned.
That's right.
And it's simple. Hey, if you want to be face first in the gutter and you like it, well, our parents would have said, fine, that's your life, go enjoy it. But the moment you stop liking that, then get up, clean yourself up, and go start over again.
Yeah.
I think we need to get back to that. And to a sense, I think, millennials almost want that because they're struggling to get access to the economy because it's this old world system. They have these great ideas. They've gotten jobs. They go to their bosses. They say, son, your daughter, this is not how the real world works around here. You play our game, and they want to play it their way. They just can't afford to do it. Well, if companies went bankrupt and they could go to court and buy these assets and get at a reasonable rate, they could revitalize these businesses into the modern world, and they'd probably do real well.
Exactly. And so I think those assets from failed businesses are stuck. And so that reduces the velocity of money as well. And also the whole idea that, and I think it was absolutely necessary. You're right. I mean, there's a social aspect to this where people were really hurting. And I think the stimulus checks, the extra unemployment insurance help individuals. And that was absolutely necessary. I can't imagine the government not doing that because, a lot of people found it absolutely necessary in order to live and survive what was happening this year. But for the businesses, it sends the wrong message, I think, to the millennials that they're, hey, look, if something bad happens, somebody's going to be there to support, me, even if I can't make it in this economy. But, when I look forward to, what's going to happen over the next year, I don't know what's going to happen, but I think we've kind of changed the paradigm here. I don't know of anybody who's like planning vacations or trips either within the United States, unless they're going to be RVing it, or traveling overseas or anything like that. At least their plans are on hold for at least a year. And then even when we do begin to interact socially in tight quarters again, people are going to be like, hey, you know what? I want a little more space. I want a little bit of this. So the economy's not, I think a lot of people are anticipating that as soon as we get a vaccine, the economy is going to jump back into full gear right away. I don't see that happening. What's your viewpoint?
Yeah, and I want to quickly just touch back on the prior subject, and then I want to get into where you're going with this. Your recent question is we stopped teaching people how to save. My parents told me how to save. Dave, Brad, I'm 100% convinced that your parents taught you how to save. We don't teach people how to save anymore. and saving is future consumption. Saving is that risk as a business. And we all been there where you're like, man, I got a great idea, but I have to risk my own money. And now we just say, God, go ahead and risk it. Someone will give it to you. We need to get back to saving money and using that money to take risks and grow the economy. Now, as far as where's the economy going? I believe we're definitely going to relapse into another recession. We could talk about, whether there's going to be another stimulus bill this year, which I've been very clear there was unlikely to be due to politicking, and it appears I'm very close to being right. The issue, as you pointed out, is travel. And, we're going to be told, we're already seeing the case counts rising back up near their all-time high. When we're not even in the winter months yet here in the United States. Well, what's going to happen? Are people going to go out and travel during Thanksgiving and Christmas? Are they going to have the money to? Well, right now it appears they're not going to have the money to travel, not to spend on, as that one car commercial says, this is a December to remember. I jokingly have been saying this next December. It can be one anyone wants to remember. It's not going to be, it's not going to be that. In my view, has been that we should not count on a vaccine, because I don't think it's highly likely. Now it could happen. And I'm not saying it won't happen. I'm just saying we shouldn't expect that. In my view, is if we would properly social distance and we treat this seriously, we could burn this thing out before there's actually a vaccine. Because a lot of people don't even consider that. Well, they just think that they're going to walk in and some blind and done. And what if it's 3 shots? Well, if they thought about how many needles you need, how many, the production of the vaccine, we don't even have the capacity to get one for everybody, let alone how are we going to, give everyone a shot? And what if it doesn't work? Or what if there are side effects? There's so many unknowns that if we would just treat this for what it is and say, look, for a while, we got to be socially distanced. We got to wear our masks. We got to wash our hands, and we need to do contact tracing. We could probably burn this thing out. But my view is we're headed, we're still in a recession, even though the stock market doesn't appear to agree with that, and that we won't really see an economic recovery probably in the beginning until 2022 is kind of what my estimates are.
Well, you mentioned the stock market again, and actually earlier you mentioned that, 1929, we saw a very sharp drop and then a rebound, which is true. And, the very high in 1929 was on September 3rd. And we also had at least the most recent high intraday was September 3rd in the stock market and the Dow Jones Industrial Average, which was interesting. but you also have a video out, and I think it was with Brent. I can't think of his list. Yes.
Brent Johnson? Yeah, Brent Johnson of Santiago Capital, yes.
Yes, I think so. It was on how stock markets are going to drive, or the banks are going to drive the stock market lower. Could you go into exactly what your idea is on that? And then we'll get on to some of Brad's topics here. But I find that pretty interesting because I see, as interest rates continue to go lower, credit standards are tightening a little bit, but they want interest rates. It seems like the banks want interest rates to go lower. Of course, they want demand, right? They want to stimulate that demand for credit. But at the same time, why would they want the stock market to go lower? It seems like that would be bad for them.
Well, not necessarily.
Okay.
When you really think about why a lower stock market is really actually good for the banks, because recessions are actually, on one hand, you think, well, recession is a terrible deal for a bank. Well, how bad was it really in 2008 and 9? I don't think any one banker went to jail. I think one guy went to jail, and I think he was just in the wrong place at the wrong time. And I don't think he worked at a bank. None of them went to jail. They all got bailed out, and they all got their big bonuses, and they act like, it was the worst thing in the world. But, there was a lot of other Americans that had the raw end of the deal, and the banks weren't on the raw end of the deal. So why are banks tightening lending standards? Well, as we talked about earlier, it's pretty obvious there aren't a lot of good borrowers. So why do they want lower interest rates when normally it makes sense from a business position of banks would want higher interest rates? Well, they do. They just know that that's not going to happen. So by getting the rates down, they're trying to starve off the number of defaults. But if the banks are successful in tightening lending standards, and then which they have, tightening lower interest rates, which tighten financial conditions, and then if the dollar rallies, you get what I call the trifecta of tightening. You get a crash in risk assets. So stock prices, house prices, commercial real estate, all that stuff comes down. You say, well, why is that a benefit to the bank? Well, simple. The federal government's going to bail them out most likely. Now, I don't know this for a fact, but I'm presuming they will come in and bail them out because the banks are critical. As you mentioned earlier, Dave, how is money created in this economy? When banks lend, well, if there's no banks, no money's created. Doesn't work. So people think, well, why do we always bail them out? Well, unfortunately, they hold a very key position in the system and they know it. So if they crash risk assets, now what are they going to do? They're going to pick up the phone and call their richest clients who have boatloads of money, right? And they're going to say, hey, guess what? I got a bunch of residential real estate homes that are in default that are now maybe 40% off. I got a bunch of commercial real estate prices, buildings that are maybe 50% off. I got a whole bunch of stocks that my primary dealer's sitting on that are dirt cheap. Why don't you come down and I'll give you a super deal on a low interest rate long-term loan. And then they'll come in. This is exactly what happened during the great financial crisis. Banks did lend, just not to regular people. They lent to the people who had the money and had the assets to back it. Those people came in, bought homes, bought businesses, bought commercial real estate, bought stocks, and got really wealthy. That's why the banks want everything to come crumbling down, because they want to put the assets in the hands of people they know can handle it.
Gotcha. And also, if you look at the FDIC failed bank list going back to 2008 early and through 2009, I mean, there were dozens of banks failing almost every single day. If you take a look at it this year, from the beginning of this year, I think there's like one or two banks that have failed. Well, maybe just because the Federal Reserve has reduced the reserve requirements to zero. And then they also, the cash requirements for banks have gone down to zero. So that's not a liability the banks have to hold anymore. I just see that there's when you talk about the Federal Reserve and what they're doing, do they sometimes I get the impression that they really don't see the big picture. They need to talk to you, and they need to talk to Dr. Hunt.
Dr. Hunt, Jeff Snyder, Professor Richard.
Yeah.
I'll take a subservient position to them. I put them at the front of the line. I think they could cover all the bases for us. But there is an issue that people think, well, banks don't need reserves, and they do need reserves because they do have to cover the risk of the loans they do have. So the reserve ratio and some of these other things have been changed to get new lending, but it doesn't mean they don't hold any risk on these other loans. And you're right, Dave. We haven't seen banks fail this year, but that's because the government has effectively said, like, we'll put loans in deferment or we'll give people extra money to make on their loans. But the risk isn't to the big banks. If you think the large commercial banks have anything to worry about, they don't. And they're real smart because they took the heat for the last recession. And we could argue that perhaps it wasn't entirely their fault, and they didn't like it. They did not like being the center of attention. They did not like what's happened since. So what did they do since the great financial crisis is they've cherry-picked loans. They've taken all the good stuff and they pushed down, say, car loans. And there are more subprime or a larger amount of subprime auto loans than there were subprime home loans. And it's all sitting in small and mid-sized banks. They pushed the equity lines down to the small and mid-sized banks. They put everything down to the small banks that they didn't want to touch. That's where we'll see the failures.
Well, that makes absolutely sense, because back in 2008, 2009, a lot of small banks, like I mentioned in the FDIC's failed list, failed, dozens a week. And we had larger regional banks and larger banks come in and swoop those up, just take over the assets. And so they're doing the same thing all over again, basically.
We'll see. Yeah, except this time the banks really large commercial banks wanted to get the heat off of them. They got the finger pointed at them, right? They got drug in front of Congress and all that. They don't want that. Now they will say, oh, look, hey, wasn't us. And then they're going to come in. Of course, they're going to buy up those banks, because what the Fed will do what they did before. It's like, here, large commercial bank, here's a subsidized loan or a tax break or whatever thing we're going to do. You go up and clean up that mess. They know it. But these small banks are sitting on literally highly toxic assets. And I'm not sure people know that. But I've known about it. I'm just waiting for the thing to go and fall apart.
Yeah, interesting take. All right, let's shift gears here for a second and get on to a couple of things that we talked about earlier before we got on the show, and that is that I agree with you. I think in principle on the fact that the dollar is probably going to rise, and I think we saw a lot of demand for the U.S. dollar in March as people got out of risk assets and they went into the U.S. dollar. But then with all the deferments and all that. There doesn't seem to be as much demand for the dollar. Dollar has declined slightly. So if those deferments, a lot of them, especially student loans, are ending in December. I think some of the furloughs on mortgage payments are still, coming about right now, and people are starting to draw down on their savings in order to make those payments. But what's gonna spur demand for the dollar again? How is the dollar going to rise? Is it going to fall here? Where are we going? And then I'm going to lead into FedCoin.
Okay, cool. So yeah, my whole case on the decline of the dollar since March wasn't due to quantitative easing, which was the big narrative that a lot of experts came and said, look, quantitative easing causes the dollar to go down. Well, it's really interesting because I've shown plenty of charts on my show. If you go back and look at the dollar versus the monetary base, or if you dug into the subset of the monetary base where you see the effects of quantitative easing, you see the dollar's gone up and you see that monetary base has gone up. So the whole notion that, okay, well, if the monetary base is going up, the dollar should go down. Well, we should have seen that 10 years ago. I mean, we should know that by now, but we don't. And so my view is the dollar goes higher because, again, as part of my trifecta of tightening, you have banks tightening lending standards, you have low interest rates, which equal tight financial conditions, and you have the dollar. So if a weak dollar leads to looser financial conditions and the other two are tight financial conditions, then the dollar bearish people are telling me the other two are wrong. Well, I can go look at what the commercial banks are doing as a matter of fact, and I can see that they have tightened. So I don't think they're wrong. And I can also look at the treasury market and see that interest rates have not really responded to all, $5 trillion of combined stimulus and quantitative easing. So I know that's not working. And the Fed is actively suppressing rates through quantitative easing. So it tells me the dollar is the odd man out, meaning the dollar has to rise. And as you just said, Dave, as all these loans are coming out of deferment, which the big months will be November and then December. And I know a lot of people, as you just mentioned, said that, my student loans are coming out in December and I'm good, but when that comes back, can't do it. That's the thing that breaks the camel's back. And so there is a demand for dollars that especially will be even more apparent as we have, 25.25 million people on unemployment benefits are now receiving less income when they were working. So they're going to have to manage the dollars they've got in savings. But as they draw those down, as you just mentioned, that creates demand. And as the global economy starts to roll over, you have all this foreign dollar denominated debt. Well, that leads to dollar demand. In fact, we just saw China yesterday do a dollar denominated loan. Why would they do that? Because they need dollars. There is a dollar shortage, will lead to a higher dollar. That will be, as I've told people, that will be the pin on the grenade. When the dollar rallies, it'll pull that. There's really no stopping what's going to come after that.
Yeah, I agree with you 100%. The majority of the debt in the world is denominated in U.S. dollars. And of course, we're the world reserve currency. And I also was really interested in what you said about the fact that the overnight rate, the Federal Reserve rate, fund rate, would not drop to below zero, would not go negative in nominal terms. And so I'm wondering actually, we could probably get into this for a very long time. We could have a very long discussion, but I do want to get into the idea of a Fed coin. Now, there is a bill pending, and you mentioned your kind of an opinion on that. If it does pass, though, it states that banks around the United States who are members of the Federal Reserve System have to set up digital wallets at banks across the country. You think it's going to pass? It's not going to pass. If it does it make any difference?
Yeah, and correct me if I'm wrong. I almost thought it went to as far as the extent, and I'm only saying this because I actually haven't read the full bill, and I'll tell you why it doesn't matter, and when we get there. But my understanding is it actually sets up accounts for consumers at the Fed. Am I mistaken on that?
Well, they're accounts at your Federal Reserve Bank member banks, but it's a Brad, you tell them because you're more up on that than I am.
Well, as I understand it, it is that like it's been proposed a couple different ways. I don't know which way it's written in the bill, but I know it's been proposed you could have a Treasury direct kind of like that access, or you would be issued a digital wallet that's connected directly to the Federal Reserve. So
Yeah,
I've seen it both ways.
I heard it was connected directly to the Federal Reserve as a way to fund future stimulus payments.
Right. So the idea being that the Fed is going to conjure money out of thin air, deposit in all of our accounts, and we're going to have in addition to the dollar, we're going to have a Fed coin that maybe is dollars, maybe it's not. Who knows what it is?
Yeah. Where are those digital dollars coming from? I mean, everything is digital already. It's just a matter of it's just going to be on a digital ledger technology platform instead of just punching it out.
Well, as far as we know, we don't really know. And so many people might find it odd that I've actually not really read the bill. I think I've looked at one paragraph of it. I have not talked about on my show. I have not been, until your show, I've not been asked about it to talk about it. I've ignored many emails or I've told people in email, like, no, I'm not really interested in talking about this. So the question is, Steve, how can you not be interested in this? This is a big deal. Yeah, well, until you figure out that it's a nothing. And how do you know something's a nothing without bothering to dig into it? Well, there's a number of ways you can look at this. First of all, we've not seen Fed Chair Powell mention this bill at any point in time, not once. Now, have we heard other Fed speakers talk about digital currencies? Well, yeah, because the central banks around the world are working on, a digital currency to work in between central banks. So that's irrespective of this. So the first way to know that this is not going to be anything is Fed Chair Powell has not talked about it, not shown any support for it, and there's no evidence of it that I've ever seen on the Federal Reserve website to show that they have any interest in it. So that's key number one. Number two is there are a lot of bills that go before Congress, and this is not the first type of bill in the history of the Federal Reserve where we've seen laws come along to potentially get them to directly print money out of thin air. There are a lot of bills post the Great Depression, and there's certainly been bills along the way. So the notion that just because a bill gets sponsored in Congress doesn't mean anything. In fact, so many of them get sponsored that go nowhere. I mean, it's not even worth talking about until actually it gets brought to the floor for discussion, and it hasn't. So a lot of people are getting really excited about this, and there's a simple way to explain how that might work. Let's say I was a congressman and I've got constituents. In fact, some of them are probably big donors, right? And those big donors say, man, we need to do some changes here. So I'm like, man, I want to keep their money flowing. So I call up, say, Brad and Dave, my buddies in Congress, and say, okay, hey, I got some big donors I need to pacify. And you go like, yeah, I got some too. What do you got? And I'm like, I got this digital currency law. Oh yeah, I got some people, bugging me about that. Great. Let's put a bill together. It isn't going to go anywhere, but we'll just throw some together, put it on the floor of the House. It won't get picked up by the speaker or anyone else that has any power to move the thing through the system. And then we'll go back to our constituents and say, look, we sponsored a bill. Yeah, great. That we know is going nowhere. And that's the whole point of this. People start to focus on these things like this, and they need to have a broad view. If something like this bill or this bill were to be held seriously, wouldn't we see it in the bond market? We would. Wouldn't we see our foreign central banks who hold a lot of U.S. debt unloading them like crazy? Sure. Would we see that auction data? Why would anyone bid on it? Why would foreign investors come bid? Why would domestic investors bid? Why would primary dealers, who are the biggest, not the biggest buyer at auctions in most cases, but they are coming to the auctions and putting big offers down to get as much supply as they want? Why would they do that if they thought the Fed was suddenly going to massively just print money and be able to buy its own debt? And so people need to take a step back from these things and realize that sometimes these bills mean a whole lot of nothing. But the hard part is the news gets sensationalized by people looking to talk about this and scare people. The reality is this bill probably will never see the light of day other than the fact that it's sitting there because it's gotten no attention from Congress. And even if it did, even though let's just pretend that the bill, got moved out of that first stage, it doesn't mean that the bill as written will be as written. And most bills get rewritten so many times, the final bill looks nothing like the original bill. And the whole notion that Congress is suddenly going to turn the Federal Reserve into a money printing machine, destroy the world's reserve currency, plunge the whole global economy into a depression due to hyperinflation, cause another war, is ridiculous.
You make a great point.
I'm
just going to give you a backstory, though, for a second. Sorry, Brad.
No, I'm just going to say, Steve, how do you really feel?
How do I?
Here's one of the reasons why I see this is so hyped and so people are so excited about it, is because the original CARES Act that they did back in March had the digital dollar, same language, in the original draft, which we got online. Everybody said, "Oh my gosh, it's going to happen. We're going to have the digital dollar," and then of course they got taken out right away, and then we had the other, the CARES Act get passed, and now it's back again. So everybody's kind of getting excited, but that's if you're into digital currencies, it's almost like the Holy Grail,
Well, and not necessarily. We don't even know what this thing is. I mean,
yeah, exactly. We don't.
As far as I know, am I going to when I log into my bank account, I don't see a Fed coin in a blank spot holding for that. I don't know businesses whose merchant processing systems have been upgraded to handle Fed coin. So you look at, we're going to start running a dual currency system in the United States. I mean, are we going to go to, say McDonald's and there's going to be two prices? Here's dollars, here's Fed coins. I mean, let's just think about how ludicrous this is. Now, will someday we get rid of paper and coin currency? Yes, we will. Will it be called a Fed coin, or will we just call it digital dollars, which is effectively what we have now? I don't know, but I don't see the United States going to a two currency system. The whole thing to me, and I encourage people is before you get excited about what goes on in Congress, go look at all the bills that have never gone anywhere in history. There's probably such a huge graveyard of paper coming out of the House and Senate. It would amaze you, but just because a bill gets sponsored means absolutely nothing.
Yeah, there's two things that ran through my mind, though, when I hear everybody talking about that. Is number one is that Powell stated that, what was the point I was going to make? They're willing to do anything at this point. They're going to, take whatever means necessary to support the economy. The other thing is that in the biggest concern that Dr. Hunt had, which I'm trying to grasp here, is that they changed the Federal Reserve Act so that they can use the reserves and flood the economy with cash, with US dollars. And that would lead to hyperinflation, very, very high, a lot of inflation. And Chairman Powell has said that he wants to try to increase the inflation rate so that it's running, their target rate was anywhere from 1.5% to 2%. They want to go a little bit higher than that. Yeah. And so I'm thinking, well, here's a way that he could do that without actually changing the law. Well, I don't know, maybe they do have to change the Federal Reserve Act in order to create the Fed coin in the first place. But then they use the reserves as collateral to fund these digital dollars in everybody's bank account if that law does pass. And that's a way for them to circumvent actually changing it so that those reserves become currency and spendable.
Yeah, reserves can't become currency. That's
not unless there's a change in the Federal Reserve Act, right? So
correct. Yeah. So let's kind of go back to the first thing you said is that the Fed said they're committed to do anything possible
to increase inflation, right?
Okay. Well, so the first, they can't create inflation. We know that. Right. I mean, and for those listening, say, well, they can't. History suggests, zoom back enough. And I always tell people, take 3 steps back, look at the big picture. If the Fed could create inflation, we wouldn't be talking. We would not have this discussion right now.
Right, exactly. It's more like they're creating deflation than inflation.
Right. Well, the Fed they were effectively created a long time ago to deal with one specific problem, inflation. I mean, when central banks came into this world, deflation wasn't an issue. So they were given all of the tools to deal with it. It was never thought that we would have a deflationary problem. So, you hear people like Jeff Snyder talk about, well, the Fed is outdated. He's right. They do not have the right tools. Now, what those are, obviously we could, have a lot of opinions about it. but the Fed is committed to doing what they can. And I tell people they're like a golf cart or like those video games where you go to the arcade, which I don't know, well, we probably did as kids, but
Yeah.
some people here are like, what, an arcade? What's that?
Yeah,
You had those games where there was a lever. It was either up or down. And then that was the whole game, right? You had a steering wheel and a lever. And that's the Fed. The steering wheel is they get out in there and talk and tell people, look, we want inflation. We're going over here. And the lever is either, more easing, by lowering interest rates or raising interest rates. Their tools are the same. It's either lower rates or higher rates. And so lower rates can lead to inflation when you get an increase in lending demand, which is, again, as we talked about earlier, why on Fridays I love looking at the lending data, because everyone that says rates are going up, the lending data says that's not possible, not going to happen. So is the Fed committed? 100%. Will it work? No. Would we need a change in the Federal Reserve Act? Yes, we absolutely would need that. Could this law on its own make that change? I don't know. Again, I haven't read it, and it almost doesn't matter because I'm politely convinced that it's never going to go anywhere. But I have a hunch that it would need to see an adjustment in the Federal Reserve Act. And we're not at the point where that's ready to happen. Look, the stock market's telling you, we believe in QE. We believe, all right? I mean, that's what it's telling you. And I try to explain to people that in order to affect change, and this is true with all of us, just as humans, if you have someone say is an alcoholic and people are like, well, I want to save them. Look, you can't save somebody until they want to change. It doesn't matter what the situation is. If I'm running my business into the ground, I'll keep running the ground until I'm ready to wake up to the music. It doesn't matter if 1 million people came and said, Steve, you're the worst businessman in the absolute world, until I think that. So the system is not ready to change because we still believe it works. So, and that's why I said earlier that it won't be till we have a recession, and that now we already know that Powell's going to come out and presuming he still is the Fed chair, if it takes that long, we don't know. He's going to do 10 trillion, 20 trillion. He's going to do whatever it takes, and it will work at first. And then when it doesn't work, that's when we'll finally realize that we have taken the system we have all the way to the end, and there is no further we can go with it. And we need to have that conversation about changing. The problem is we should have been having that conversation after the great financial crisis, but we didn't. That's the challenge.
Yeah, well put. Really well put.
Very well put. So look, I know we're getting about an hour. I don't want to go too much longer, but I do want to just touch one more topic, which we kind of just lightly touched, was velocity of money. I'm seeing, a number of components from this conversation that need to happen in order for this economy to head back into a healthy waters again. And a couple of those things was austerity and learning how to save on a consumer individual level, right? And then the velocity of money. I happen to feel that, the velocity of money, distributed ledger technology, and what it can do for the correspondent banking system, commercial banking system, the central banking system is enormous. It can help them release the dormant capital that they have in these Nostro Vostro accounts so they can have access. I mean, I think we all know from the great recession we had before, the hedge funds and all went down, the central banks bailed them out, right? And now the central banks are in trouble and they have nobody to turn to except potentially this technology that can unlock that dormant capital for the first time in cross-border payment history. What say you, your thoughts on that, Steve? And then I want to get your thoughts too, Dave.
Yeah, I think distributed ledger technology is going to have a big role in the future. Now, I will go on record to say I do not think it will be an existing technology in terms of I don't think that Bitcoin itself will become the world's reserve currency. Now, maybe something looks very similar to it, but the notion that the central bankers of the world are going to turn over the control of the currency system to an existing system, they're not going to let that happen. Now, it doesn't mean it couldn't happen if the power of the people turn it into that. I'm just saying that central bankers aren't. The issue with the velocity of money is not solvable by a cryptocurrency. And so the question then is, why is the velocity of money so low? And it's simply a function of government debt. And so if you take a chart, if you go to the St. Louis Federal Reserve database called FRED, and you can look up, and if you don't know how to do this, go to your favorite search and type in FRED, velocity of M2, and it'll pull up that chart. Then go and back to your search engine and type in Fred total government debt and get the little code, and then open up your velocity chart, add the government debt code to it, and it'll overlay the two. Then invert, which you have to do a little math, invert the government debt. And what you will find out is as governments take on more and more debt, the velocity of money goes down. Now, why is that happening? And why will a Fed coin or DLC not fix that problem? Well, it's simple. There's a certain pool of dollars, and you have to think of it as like musical chairs. So we're all playing every day. There's a certain pool of dollars, and there's a greater demand for all those dollars. So we're all circling, this pile of dollars in the room, and the music's playing. And then all of a sudden the music stops. But before you and I, the three of us, are allowed to go in our hands, the federal government comes in and takes their piece first. That is the important piece to understand. The federal government gets their hands at the pool of dollars before everyone else. And then the rest of us, then we go and fight for it. So what we see in the data is as government borrows more money, the velocity of money goes lower and lower, and the labor force participation rate validates that fewer jobs are available in the economy. So what we will see from the pandemic is there will be permanent job losses, and it will be at the hands of the government and all this borrowing. And so the solution to the problem to get the velocity of money higher is the government needs to cut its spending and ideally run a surplus and give the power back to the people. Now, the notion is, well, if we had a distributed ledger technology, it would give the power back to people. The answer is the government will still need their piece because they got to pay on all this debt. The solution is the government needs to shrink and give the power back to the people and let the people who can create money, which is us by going out and borrowing, create more money and revitalize the economy. Till that happens, the velocity of money will probably spring up a bit in the third quarter, and then it'll roll over and head lower.
Dave, your thoughts?
So I've expressed my point of view on this for a very long time. I think that one of the big points that central banks want is data, and they want all of the data. They want, if central bank digital currency is allowed between central banks, they want that data. If a Fed coin or whatever it's going to be called is going to be created, they want that data because all of the transactions are going to be transparent and visible on the ledger. And so they want to know where all of the, where everybody's spending their money, and where's the slow areas of the economy, where's the fast areas of the economy. And then they're going to use AI in order to try to regulate, instead of having market forces, which we grew up with. Market forces will determine the price levels of certain items and commodities and everything else. They're going to use AI through digital ledger technology to give those price points for us. So almost a little bit like price control. So I think there's the big thing for me is the Fed wants the data. The central banks want the data, and they see it. And so they can point that out. Steve's shaking his head no. But
so let me give you. I'll give you a different view. They already know where the data is, and we can go to companies like Amazon and find out. So here's why I do not think
all that data is available to the government now.
Yeah, well, I mean, yeah, they can get the data. I mean, Google has, or is it Google? I can't remember who has that Million Prices project. I mean, there's real-time data out there. The Fed actually just doesn't use it. So they actually could find out where the money's going. They just don't. So
I'm talking about at an individual level almost.
Right. and they don't care about that. And I'll tell you why we will most likely not see blockchain technology be in our day-to-day use of transactions. Is too inefficient. So let's say that I go down and buy a cup of coffee from, some major coffee thing. Do we really need to know, how much I spent, the size of the coffee, all the details about that transaction? Nobody cares. Because if we really need to know, we can just contact the store, find out when Steve was there, get the copy of his receipt, and we can find out exactly what he ordered. It's irrelevant. The current payment processing system is super fast and super efficient. We don't need a whole entire system to validate when I go buy a cheeseburger that maybe what toppings I got on it, and then I have to wait for the ledger to, for everyone to agree on it. It's too inefficient. The Fed doesn't need that level of detail at all. Now, maybe on a broad level, they might want to know, but at a micro level, you're going to see people stand in line while they're just sitting there like, all right, well, is that going to, when's the ledger going to confirm this transaction? Whereas right now I can pop my credit card in, and within 3 to 5 seconds, I get transactions confirmed and I'm out the door.
Well, there's digital coins, including one that Brad and I like called XRP that already do it in 3 to 5 seconds.
Yeah,
Right.
and
Well,
it's not for hair.
we
It's
need
not for
something more
haircuts.
efficient.
Yeah, and it's not for haircuts or coffee or shoes, right? Like the
No,
the
no.
real intended use of like the DLT and the particular token that we follow has been really pretty much embraced by the central banking system, and the DTCC and things of that nature appear to be doing pilot tests with those technologies. And obviously we don't have all that data up front, but I think we all realize that if something's going to come into place, you're going to need the foundation before you have the roof on the house. And they're going to end up, when they do make that shift, I would believe, from what I've seen, that, they would make that shift to use something back end, to get that working back end first before we see something like, because we're not referencing Bitcoin, because like a Bitcoin takes 6 hours to settle or whatever the hell it is.
Yeah, that's not going to work.
It's essentially a Ponzi scheme everybody politely refers to as a store of value, right? So, but what we're actually talking about is a slightly, actually quite different technology that has been embraced by the Federal Reserve Faster Payments Task Force. It's been cited for solution for cross-border payments. It's actually been cited as a rule that's been made effective in the Consumer Financial Protection Bureau for transparency between sender and receiver for cross-border payments for banks and credit unions alike around the world. So the technology certainly proved out, but I think you make some very good points that, this isn't something you see quickly on the front end. Like, I mean, you're going to see, obviously, we know PayPal is going to roll out the option to buy cryptocurrencies on their platform, but that's participating in almost like an investor buying opportunity, right? But in the way of seeing, your local grocer accept, the money for lettuce in Bitcoin versus a digital dollar is a way down the road, just so we understand, because I know this is our first time having a chance to talk or what have you, but I definitely see the tech that we're looking at with XRP and Ripple strongly being a back end tech that they could put in place first that is at a upper tier level, and then obviously it could be used on a lower tier level through the remittance companies and remittance corridors to build and deepen those liquidity cash pools in that area.
Yeah, I've always seen this as a two-tiered system, and minimally. Yeah. So, for example, I go get a mortgage. Maybe that's where you do really want the blockchain. You don't care about the 6 hours to settle, because what we want to do is know, okay, Steve got a mortgage. When is he making his payments? And we want that ledger, and we want that accessible. But yeah, you're right. If I go down and buy a cheeseburger, we don't have 6 hours to wait for that. We need a fast, efficient system that does do things that is secure and does all the things you mentioned, but then can play with that other system when it needs to. And you're right. Are we going to have that technology someday? Yes, we absolutely will. Will it be, what's on the current slate? I don't know. Maybe it'll be something even better. And what's great is at least central banks are starting to look at it. Now, anybody who thinks going to a cashless society is a great idea, it's not. It won't be. And the moment people find out, oh, I didn't pay my taxes, and you get on an airplane to go to Europe and you find out that you're not allowed to go anywhere because your accounts are now showing zero for a while until you fix your problem. Yeah, that's not so great. But, we headed that direction. Absolutely. And whether it be a 2 or 3 tier or a multi-tier system, I don't know, but it's going to have to be.
Yeah, and I loved what you said in one of your videos. Was it 2008, 2009? We had a recession and things were pretty bad, but hey, we're still around and we're still surviving and things keep moving along. And and I think the same thing's going to happen now. It might just be a little bit longer time, but I love your perspective on it because it's very, very level-headed, long-term, and I just love the way that you presented that. So, and it was reassuring.
Well, yeah, thank you. Because I'm not doom and gloom in perpetuity, because I believe that, Americans and humans around the world are very resourceful. We're just not being given the opportunity to apply our resourcefulness and our knowledge. We're being restricted from that. But there will be a time when finally, the central banks and everyone else will go, wow, that didn't work. And now we need to bring out the best and the brightest and really look at all this technology. And maybe none of what we have available today is right, but it can be a foundation to be like, okay, well, what's the weakness of this and this and this? And can we make something better? That's what we need to get to. And in human innovation, man, I'm 100% behind that.
So am I. I agree with you
Absolutely.
100%. Innovation is key.
Yeah, absolutely. Guys, we got to wrap this thing. This has been incredible. Dave, as always, I appreciate you. Steve Van Metre, tell people one more time, name of your YouTube channel, where they can find you. You're just wonderful insights. Love it.
Well, thank you. So as you mentioned earlier, I do a macro YouTube show 3 days a week, Mondays, Wednesdays, and Fridays. I do a chart show on Sunday afternoons for people who like to look at charts. But essentially what I do is I talk about the data, the real data, and I don't require people to agree to my opinion. I give you my opinion on it. You're not required to agree with it, and that's great. I want discussion. I want people to disagree with me, and I want people to understand it. But we talk about the data. It's not the most sexiest show on the planet because we get to the real stuff and we try to understand it, because I want to empower people to make better investment decisions, better financial decisions. And macro, sometimes it's like watching a snail crawl. It's not really exciting, but that's the best place they can find me is on YouTube. And I'll look forward to any and all of your guests and viewers that want to join us. More than happy to have you.
Steve, I have to disagree with you, though. Your show is very exciting and very sexy.
Well, thank you. I mean, I appreciate that. And I hope more people, start to see that, when you understand macro, you can make life-changing decisions, not only for you and your family, but your future generations. There is a story that went out, I don't know, last year about something my father and learned and did, and my mom really wasn't excited about it, but it changed the entire course of our family's future. And it was a macro decision. He trusted the advice he got from some people and he executed it. And I learned from him and our change as a family growing up that, hey, we're living in a neighborhood we shouldn't be, and we don't make the money everyone else makes. We don't have the things that everyone else has. But we made that step. And because of that step and what I started to learn from my parents, that I'm like, wait a minute, recessions are opportunities. I got to put myself in a position to take advantage of that so I can change my future and then maybe, my kids' future and grandkids' future. It's one step at a time. But macro teaches you how to do that.
Absolutely. There's always an opportunity someplace.
Yeah, well said. Steve Van Metre, thank you so much. Dave Vallieres, you guys, I'll tell you something. It is a pleasure and honor for me to be able to sit in and MC this conversation because I've learned so much. I mean, this is wonderful. Steve, I hope you will come back and see us soon on the show here.
Brad, Dave, the pleasure was all mine. You guys are absolutely fantastic. I think your show's fantastic, and I hope more people listen to it and learn more about the concepts and things that you guys share on this show.
Thank you so much.
Appreciate that so much, Steve. Thanks for coming on and your generosity and your time. Much appreciated.
Absolutely. Have a great weekend, guys.
Thank you, and I'll look forward to the next time.
You got it. Take care.
Bye.